Gary Thomas from the Wealth Technology Group and host of On the Money on our news station, WHMP. The President of the United States has been on campaign tour, sort of, but campaigning not just for another term as President of the United States, focusing specifically on college loans and the interest on college loans. He has said some staggering things. The one that sticks out most to me is that the President of the United States said he didn't finish off paying his own college loans until 8 years ago.
The student loan debt is growing. It is greater than all automobile debt combined. It's greater than all credit card debt on the books right now. Average kid getting out of school finding themselves with, on the low side, about 12.5 of student loans, and on the high side, in the tens of thousands. Meet with many people that go to graduate school. They come out with $40,000, $50,000 and more. If you go to medical school, not uncommon to have over $100,000 worth of student loans. Right now, the student loan interest rate is fixed at about 3.5%, somewhere in that neighborhood.
So as far as loans go, that's a low percentage loan.
It's a pretty good. It is a good rate for a long-term kind of investment. Thing about student loans, though, they do have a very high default rate compared with the rest of the
I thought you
economy.
couldn't default on your student
loans. You can't. They'll get you. They'll attach your income tax return. They'll attach your wages. You can't discharge them in bankruptcy. Nevertheless, sometimes it is hard to get that money. But what happens is that the way back in 2007, Congress fashioned a deal basically to lower the student loan rates, to keep them low, and then just like everything that just has to have an end, they were scheduled to double to 6.8% coming up, I believe, starting in July. And now the thing is it makes a huge, that difference between paying 3.5% and 6.8% makes a huge difference over the life of the loan. Just sort of as a rule of thumb, money doubles in the number of years that it takes the interest rate to go into the number 72.
What?
So if you were now,
so you divide 3 by 72.
So for instance, if you were paying 7%, or if you had an investment, if you will, at 7% compounded, basically, and you had a $100,000, $10,000 investment. And if you divide, 7 into 72, it takes approximately 10 years, basically, for that money to double.
Which means you will pay twice as much as you borrow.
Exactly, and assuming you're not reducing the principal significantly along the way. On the other hand, at 4%. It takes 18 years.
So you got that long window.
Money to double.
I remember getting those stubs and paying off my student loans and seeing how little of it was going towards principal and feeling how
paying for interest
terrible that was.
First, just very little on principal. Now what's happening is it's becoming more and more difficult for students, that many of which have been out of work for 1 or 2 years after school. And we need to make some situations where deferments get to be longer, so that, yes, the interest continues to tick, but not at a high rate. And number two, that if we don't lower these interest rates, the students are going to be basically tagged with staggering debt.
As if they're not already.
Right, basically, that's growing. And that's really, that, to the extent that you're repaying that debt, you're not investing in consumer goods, and you might delay buying a home. Now the real question is, Congress is subsidizing these rates, and both Mitt Romney and the president agree that, quote unquote, something needs to be done here. The real issue is like everything else, when this gets to Congress, I know you're going to hear the same argument, well, it's going to cost us, the government, so many billions to subsidize the student loan rate. Where's the money going to come from? Whose pocket are we going to take it out of? And, frankly, we don't need to take it out of anybody's pocket.
We just don't need to make the kids pay so much back to us.
At this point. Now, on the other hand, that's one way to subsidize the loans. It's another thing to say to banks or other institutions, we're going to cap the interest rate that you're going to lend at. And if they if they say to you as a banking institution, well, you could only get, say, 5% or whatever on any particular kind of loan, then that's going to severely limit who you decide as an institution to give loans to. You're only going to give loans to the people with the most impeccable credit. So we have to be careful because many people say, well, why don't we just make the banks or make the financial institutions, why don't we just cap the interest rate? Well, yeah, you could do that. You could cap the interest rate that they can charge, because make no mistake, we're subsidizing these particular loans, many of which are direct loans now. The government is getting moved into the direct loan business instead of having the bank as an intermediary. But if you're going to have but we can't lend to everything to everybody. So if you're going to tell a financial institution, all right, you can only charge 6% on this or 5%, then you're going to limit who gets those loans, because they're going to limit their risk based upon repayment history and things of that nature.
So maybe it needs to go up a little bit, but it shouldn't go up double.
If it doubles, it is going to have a staggering effect on the future. Already it has an effect where folks are coming out of school, they've been out for 1 or 2 years. And then it's not just people out of school, it's people that have been out of work for 5 years, 6 years, 7 years, still paying on those loans, went into work and found out their job wasn't there. Well, by this time they have a mortgage payment, they have a car payment, they have a student loan payment. Let's not try to make it any harder for them. Let's try to provide some relief until they get over the hump. And then as things get percolating, those rates can go up.
And if even the President of the United States is paying back his student loans only 8
amazing.
years ago.
Absolutely amazing.
Not everybody can write a #1 best-selling book to try to help pay them off and then get a nice cushy government job, Barack Obama.
It's a big number. It's a big, for many people, they owe as much as they're, purchasing their first home. You come out, I was talking to a physician who basically had a situation where she is working in a low income based hospital, so she got somewhat of a break. So she comes out with only 50 grand worth of student loans, but I mean that's a big number to pay off over a period of time, especially if you're like most people, your income when you first get out of school isn't spectacular, and it takes you years to get a decent income. So I'm all for a subsidy. I think you're going to see some congressional wrangling about it, even though both candidates, even though the president and Romney seem to agree in principle. Wait till it gets to Congress, you'll see a fight.
Gary Thomas from the Wealth Technology Group, host of On the Money on our news station, WHMP.